Looks like we're now live. At least that's what I'm seeing on my screen. Who's got the thumbs up from Casey? So I think we're good to go.
All right, good to go.
Great.
Excellent. Well, welcome everybody to the Committee on Taxation. Sorry for our slight delay with some technical issues, but we're now going to get started. We'll begin as we usually do with introductions, and we'll start with Senator Pouliot.
Hi, Senator Matt Pouliot, represent Senate District 15.
Representative Bickford.
Good morning, Representative Bruce Bickford. I represent House District 63, which is part of Auburn.
Excellent. Representative Carmichael.
Good morning, I'm Representative Mickey Carmichael. I represent House District 137.
And Representative Collins will not be with us this morning. Representative Gramlich.
Good morning. My name is Lori Gramlich, and I represent House District 13, which is the lovely seaside community of Old Orchard Beach.
And I don't see Representative Hanley with us. Representative Steckes is now a member of the committee, but he's not with us at this time. He'll be taking over for Representative Kryzak for the time being. Representative Matlack.
Good morning. I'm Ann Matlack. I represent House District 92, which includes the communities of Cushing, Thomaston, South Thomaston, St. George, Matinicus, Creehaven, and the Muscle Ridge Islands.
And Representative Perry.
Yes, good morning. Thank you, Mr. Chairman. I'm Joe Perry. I represent part of Bangor and Orono in the main house.
Excellent. Representative Sachs is in another committee working on one of her bills, so she won't be with us this morning. Representative Terry.
Good morning. I'm Mo Terry. I am a representative for District 26, the west side of Gorham, and I serve as House Chair. Good morning, everyone. Thanks for coming.
Excellent. I'm Senator Ben Chipman. I serve as Senate Chair of the committee, and I represent Senate District 27, which is part of the city of Portland. Also with us this morning is our new committee clerk, Lena Braun, and Julie Jones, our committee analyst. Today we're gathered not for work session or public hearing, but rather just the presentation of some reports that we will hear from our analyst on, Julie Jones. If folks have questions about anything in the reports, just as a reminder, please use the raise your hand function on the Zoom screen and we'll call on you. There's unfortunately nobody from OPEGA can be with us this morning, so there may be some questions that are more detailed and Julie may not be able to answer, but she'll do her best. If there's any questions she can't answer, she'll make a note of those and we'll have OPEGA folks come back and join us at some point in the future to answer any questions that Julie can't answer. With that, anything else that you should want to add, Representative Terry, or are we good to start?
No, we're good to start.
All right, great. So we'll get started and I'll turn things over now to our analyst, Julie Jones.
Thank you. It's a little difficult to begin a presentation like this. The idea is to get you started on tax expenditure review this session, but you're all coming at it from different experiences. Some of you have been doing this for a long time and are very familiar with how the process works, and some of you are pretty new. And some people who aren't here are brand new. But the tax expenditure review, well, first of all, what is a tax expenditure? I brought the statute with me here too, so I can, it's one sentence, don't panic. So I can read it to you. Tax expenditures, it's not necessarily a common term unless you're involved in the tax policy area, but a tax expenditure is defined in Maine law as state tax revenue losses attributable to provision of Maine tax laws that allow a special exclusion, exemption, or deduction, or provide a special credit, a preferential rate of tax, or a deferral of tax liability. So it's basically just what we would call a tax benefit that state law provides to people who would otherwise be paying taxes with regard to that. The Maine legislature has been involved in one way or another in reviewing tax expenditures since at least 1979. But in the early stages, it was much more of a subjective review. The taxation committee had a schedule where it would review tax expenditures on a 4-year rotating basis. At that point, early on, it started out as sales and property tax exemptions. At some point along the road, property tax exemptions were dropped, income tax provisions were added. But the taxation committee would get together and review, learn what the provisions were, usually ask for public comment, but the public comment was about all it got in terms of analysis. And you can imagine the people who came and commented were most frequently the people who were benefiting from the provision. So the taxation committee would then decide whether it wanted to make any changes. And there were some changes over time, but it wasn't really a very effective evaluation process in terms of determining how the tax expenditure was performing, whether it was accomplishing what the legislature wanted it to accomplish when it was enacted. Eventually, that provision of the taxation committee having a 4-year review process was dropped in favor of Maine Revenue Services submitting information to the committee, and the committee looking at that information. The Maine Revenue Services document that was submitted is what we now know as the Red Book, which comes out every 2 years. They still do this. For a period of time, that was the only aspect of tax expenditure review. In 2013, there was a bill in the legislature to study the tax expenditure review process, and a committee was appointed to do that and worked with OPEGA and OFPR to eventually come up with a process that the legislature enacted in 2015, which is our current process. That process sets up 3 levels of tax expenditures. There are full tax expenditures, full review tax expenditures, excuse me, which are defined as expenditures which are intended to provide an incentive for the taxpayer to engage in certain types of activity, which benefits a specific group of beneficiaries, or for which the goals are specific and measurable. The process identifies OPEGA as the office that will be doing that analysis for the legislature. They review full expenditure reviews and provide reports to the legislature. Private reports to, first of all, to the Government Oversight Committee and to the Tax Committee. They're, of course, available to the full legislature, but the full legislature is not the recipient of the reports. Originally, the process was a 6-year revolving process. With regard to the full reviews, it required that they were taking quite a bit of OPEGA's time to do the evaluation, which is quite detailed, and to provide the reports. And there were quite a few of them. So a 6-year rotating cycle was not going to be enough. And the legislation was changed a couple of years ago so that with regard to the full expenditures, a priority is established, and OPEGA does those in the order of priority. Several have been received and reviewed by the Taxation Committee already. You have 3 before you this year, 2 that we'll look at as an overview today: the Better Betty programs and the Maine Capital Investment Credit, which is an income tax credit. The second category of reviews are called expedited reviews. Expedited reviews are ones where the legislature has not necessarily identified specific goals for specific expenditures. They tend to generally be sales tax exemptions, and the definition of an expedited review provision is one which is intended to implement a broad tax policy. So at the beginning of this process, OPEGA, Government Oversight Committee, and Taxation Committee, essentially all working together, came with identification of which tax expenditures should fall into which category. OPEGA and the Government Oversight Committee reviews that every year, actually, in consultation with the Taxation Committee, and proposes, if they have any recommendations for changes, which would then be reviewed by the committees and implemented. They can be the categorization can be done without statutory amendment because they're not specifically specified in the statutes. There is another category of tax expenditures which are not reviewed. Those are ones where the loss of revenue is estimated annually to be less than $50,000 or that otherwise do not warrant review. Again, it is the two committees in OPEGA working together which identify which provisions fit into which categories. The two that we're going to review today are both full review provisions, Better and Betty, and main capital investment credit. Let me look at my notes and figure out what I've forgotten here. Oh, okay. Well, the first step in the process of both of these is once they've been identified, OPEGA begins the process of gathering information in order to come up with a report. They get information from Maine Revenue Services, from the legislature, from members of the public who may be recipients of those credits. And the first step that they do is to try to identify the goals, intents, and purposes of the provision. Some of the older provisions, that's very difficult because the legislature isn't always or hasn't always been in the practice of identifying goals and intent and purposes when it enacts a tax credit or a tax exemption. So OPEGA does its best to try to identify, looking at legislative history, what the legislature was intending with regard to an older provision that when it's beginning review. Again, it checks all of that through the Government Oversight Committee and with review by the Tax Committee. But in more recently, especially since this process has begun, the legislature, largely the Taxation Committee, has become attuned, and sponsors too, to a certain extent, to the fact that the legislature should be identifying these things when it enacts a new provision. So when you see provisions now for new credits and exemptions, they will frequently have provisions in them that identify the legislature's identifying these are goals and intents. And it's establishing that framework. So OPEGA does, and the two committees don't have to go through that process ahead of time. What happens after those, in terms of OPEGA's evaluation, once they have identified the purposes, intent, and goals, which they fondly refer to as PIGS because it's P-I-G, it's an acronym. But that's just for us insiders. That's not for anybody else. I'm joking, of course. They proceed to perform the evaluation in terms of determining how the credit or how the tax expenditure is living up to its to the legislature's purposes, goals, and intents. It comes out with a report. They make findings in their reports. They make recommendations in their reports. It's varied over time. I've noticed that sometimes report will have findings but no recommendations, and sometimes it will have recommendations. So it varies in terms of what are in the reports, but in general, it provides you with that information. Once the report is finished, they send email copies, and paper copies are available for the Government Oversight Committee and the Tax Committee. But the first actor in that process is going to be the Government Oversight Committee. They are directed by statute to review the report to determine whether OPEGA has used the proper analytical process and has provided an acceptable report. They also tend to, when doing that process, they tend to get into the substance a little bit, although the statute and framework does not direct them to address the substance. They care about those kinds of things, and like you all do, and so they sometimes discuss them and get involved in that process. But ultimately, they endorse the report as being appropriately done report, and transmit it to the tax committee. At that point is when it comes under the tax committee's jurisdiction. The taxation committee is directed by statute to review the government oversight committee's review of the report and other materials they submit you, public comments that they receive, because they're required to hold a public comment session on each report as well. They send those to the taxation committee for your review and recommendations. The taxation committee is required to review the report and is authorized to make recommendations and to submit legislation. So each report that comes to you, you are directed to submit a report of your activities to the full legislature. That can be as simple as a memo that says we've reviewed the report and it looks fine to us. We have no recommendations for change in any of the tax expenditures. And some of them have been that brief, or it can be detailed. You may go into a provision in some depth, and you may come up with recommendations that you want to explain. So it may be a longer report. It varies depending upon your approach to them. So the two that you're looking at this morning are the Better Betty program and the Maine Capital Maine Capital Investment Credit. Oh, the other thing I should mention is, I hope the YouTube link is working, because I know some of the people from Maine Revenue Services, I think, are listening in. And at some point you may want to have them come and give you a more in-depth briefing on the actual tax provisions that are subject to your review. The OPEGA reports go into quite a bit of depth of what's in the provision, but you may have more questions, and I'm talking on a lot, but feel free to interrupt at any time and ask questions, or save them up to the end, however you prefer. But it's anticipated, I think, that today is an overview, not necessarily the end of your work on these projects. I have a couple of charts which were emailed to you last week and are online, as I mentioned when we looked briefly at the materials page earlier. But with your permission, I'm going to screen share the chart. I don't know if people were able to print it out. I know sometimes it's awkward for you at home to do so, or even apparently awkward for some of you to get the emails opened, which we're going to have to figure out what's going on there. But is it okay if I share screen?
Yeah,
Sure.
absolutely.
Okay, share screen. There it is. Okay, are you seeing it?
Yeah, I don't know if there's any way to make it any bigger, but we can see the document.
There is a way to make it bigger, and I'm going to do that now.
That's perfect.
Yeah, that looks
Okay.
good.
Okay, I don't know, I'm looking at it on my other screen, and can I move it over to the main screen? Sort of, yes, here I go. That way I don't have to, okay. So I've already talked about some of the original stuff.
On our screen, it's now just a narrow strip down the middle of the screen. We can't see
Never
anything.
mind, okay, it's going back. Okay, how's it now?
Yeah, that's
That's
good.
it.
Oops. Full screen, okay. Some of these things I've already talked about at the beginning. The why are we here? It talks about full reviews and expedited reviews. Better Betty, this is a chart on Better and Betty, is a full review provision. Better and Betty are actually two separate programs. Oh, and I have to do the items in the notes first. I got to do this in the right order. My brain is a little spacey today, I'm sorry. OPEGA completed its evaluation of Better and Betty in February of 2020. you may say that's a long time ago. Why are we just seeing this now? And that's because if you'll recall, February 2020 was the very beginning of COVID's assault on the world as we know it. And the legislature was in the process of trying to speed up all of its activities. What has happened with regard to both this one and the main capital investment credit, which was received much more recently, but is that the committee has found itself with a lot of bills during a regular session usually, and needing to deal with those bills rapidly because the legislature in both 2020 and 2021 was interested in taking care of its business as rapidly as possible. So it didn't have to expose people any more than necessary to possible contagion. And what happened in 2020 and also in 2021, in both instances, although most of you were around in 2021 because you were on the committee, tax committee, but the committee was rapidly trying to finish off bills. I think that assuming that it would deal with the tax expenditure reports once the bills were done and activity was on the floor. But when that time came, there just wasn't time for the committee to hold meetings because you were in session all the time in the House and the Senate. So it kind of got delayed over this period of time. That's the reason for the almost 2-year time lag now with regard to this particular report. Better and Betty are two separate programs, but they address the same issue. The Better program, which began in 1990, well, it was enacted in 1995 and first took effect in 1996. Provided for state reimbursement to eligible businesses for eligible property that was subject to property tax. So the business would pay its property tax and annually submit to Maine Revenue Services a request for reimbursement of those property taxes. They could do this for 12 years as long as they were maintaining the property in use in their business for that period of time. Over the years, many people said, why are we having this process of them paying the property tax and then having to get reimbursed? Why don't we just give them a property tax exemption? And in fact, that change was made in 2006. The Better program, to a large extent, was replaced by the Betty program. Same property that was eligible, with a couple of exceptions. But for going forward, it's for property placed in service after 2006 or beginning in 2006, I think, that property would be exempt. If it had been placed in service between 1995 and 2006, it was still subject to Better. The legislature at that time, though, changed the process to make Better ongoing as long as the property was still in use. So although they adjusted it a little bit to provide that under the Better program, property that was still covered under the Better program, which is mostly older property, plus retail sales business property, which had not been previously covered under Better, but it was added when Betty was enacted. It's covered under Better instead of Betty because the legislature preferred to do it that way with regard to retail property. So after 12 years, it continues to be eligible under Better, but the amount decreases each year until it reaches 50% in the 18th year. And then it goes on at 50% until it goes out of use. If it's no longer being used, then it's not entitled to either program. So the Betty program provides a 100% property tax exemption. Most of you are probably aware that there's a provision in the Maine Constitution that says that if the legislature enacts a property tax exemption, it has to reimburse municipalities for at least 50% of the revenue lost to the municipality as a result of the exemption. So the legislature, in enacting Betty, obligating itself to pay at least 50% to the municipality of the lost taxes. What they enacted to do was to, in the first, it started at 100%, but it declined fairly rapidly over the first few years to the point where the municipalities are now getting reimbursed for 50%. So they're not getting reimbursed for the whole thing, even though the taxpayer is getting a 100% exemption. So it becomes like other tax exemptions that the legislature reimburses for. I think the only other one that's not at 50% is the homestead exemption, which has different amounts. It's not 100%, but it depends upon what year you're talking about. It's more than 50, somewhere between 50, usually 60 or 70, I think. Anyway, so we have these two programs which cover the same businesses, the same property, but it depends upon at what point they came into the process. Okay. Okay, so I've gone through what are Better and Betty. So the next question is, what are the purposes, intent, and goals? What OPEGA evaluates with regard to Better and Betty. When Better and Betty enacted, the legislature was not required to, well, it still isn't really, but didn't really see a purpose, I guess, for including purpose, intent, and goals on everything. Although when it enacted in Better, it did provide some information to indicate that its intent was to reduce the cost of owning qualified business equipment. OPEGA also looked at the credit in its history and how it's used, and identified another statutory purpose to provide an intent for the growth of capital investment by the purchase of new business property in this state. Okay, it gives you the statutory references. Better is in the reimbursement provisions in Title 36, and Betty is in the property tax provisions in Title 36. OPEGA in this report seemed to orient the report around its findings, and they're not exactly in order on my chart because they're sort of not in the same order as my chart is. But the OPEGA finding with regard to this particular item is finding number 2, which is that the goals and intended outcomes against which Better and Betty are to be evaluated are unclear. Specific goals and intended consequences have not been identified, meaning, results to be reached as a result. And they've indicated that including well-defined objections and evaluation criteria indicating that it's useful to them to know what the legislature would like them to use as criteria for evaluating an exemption. Essential to them for the purpose of evaluating program performance. If the provisions are old or even new, and the legislature has not provided guidance, OPEGA will try to identify what the legislature probably meant, working again with the Government Oversight Committee. And part of the process is that when OPEGA begins a review, it does go through the process of identifying these if the legislature has created them, but also trying to identify them even if the legislature hasn't, so that they do have something to evaluate and measure. You will become part of that process. Once they start that process, that process comes to you before they even start their report. And if you want to say, oh no, that's not what we meant, then you can have that input to them. Or if you want to give them more information that would be helpful to them, you can do that too. One of the things that I put on your monthly calendar is an indication that the Government Oversight Committee is meeting this Friday. One of the things they have on that list of things that they're going to do, a variety of tax expenditure items that they are going to review. One of which has to do with the historic rehabilitation credit, which has not been reported on yet. They're going to receive public comment on that credit. They're also going to look at the items on the tax expenditure list in terms of priorities. When they have done that, their work will come to you for your comment, opportunity to comment back to them. And to the extent that believe the next full review that's on the list is the research expense credit, income tax credit. Once they have come up with their evaluation parameters, again, you will receive that information for your review and commenting. But in this instance, with regard to Better and Betty, based on direction from the Government Oversight Committee, with an opportunity to comment by tax, OPEGA evaluated the Better Betty programs based upon reducing the cost of owning qualified property in comparison to other states and countries, and encouraging growth of capital investment in Maine businesses. So they're looking at, and I think one of the issues with regard to Better and Betty was Maine's competitiveness compared to other states. Some states don't tax business property in this area, others do. So it was intended to increase Maine's competitiveness in attracting business investment.
Excuse me, Julie.
Yes.
Representative Bickford, do you have a question?
Yes.
Yeah, go ahead, Representative Bickford.
I do, thanks. Julie, my question is, when it comes to what tax expenditures are reviewed by OPEGA, shouldn't we be determining our priorities and giving them to Government Oversight Committee, not the other way around? We're the tax committee, right?
Yes, you are.
Thanks.
I think, and OPEGA, generally speaking, works for the Government Oversight Committee.
Right.
So the Government Oversight Committee has worked into that process. And part of, and what happens is when they review that, the Taxation Committee also has the opportunity to provide input. And to the extent that the Taxation Committee has provided input in the past, it has definitely been taken into consideration with regard to the ultimate parameters for evaluation that are adopted.
Okay, thank you.
And I mean, the Taxation Committee has the opportunity by statute to introduce legislation. So if you want to address that issue and change it on statutorily, change the process by which things are done, that's always something that you can do, of course. But that is the way it is right now because OPEGA works primarily with regard to the evaluation process itself, is sort of part of what their jurisdiction is.
Right.
And the legislature decided to do it this way.
I understand that, and I'm not saying that we want to direct OPEGA. We want to
Yes.
let Government Oversight Committee know what our priorities are.
Yes.
Because we're the tax committee, they're not.
Yes.
All
And
right,
you will be provided that opportunity to let them know when they are considering prioritization and categorization. And like I said, to the extent that you want to review the process itself, the other thing it's a good point to mention now, I was intending to mention sometime today, is that the legislature last year, in fact, did create something called the Tax Expenditure Review Working Group, which was made up of four members of the Taxation Committee and 4 members of the Government Oversight Committee to look at the process itself and to come up with recommendations for whether there should be changes. Your House Chair, Representative Terry, was the House Chair of that committee. The Senate Chair was Senator Libby, who is the Senate Chair of the Government Oversight Committee, but is also a member of the Tax Committee, so he's very familiar with the Taxation Committee's role. And that report, which you will be reviewing at some point soon, I don't think we set a specific time for it yet. The Government Oversight Committee will be looking at that report at their meeting this Friday. You might want to try to listen into their report and to see how they do things. I know Representative Matlack has done that quite a few times, listened to their, or actually attended when they hold insight meetings, but this is not an insight meeting. It's a totally Zoom meeting, so it would be through YouTube. They welcome Taxation Committee member participation in those meetings, so you're always welcome to come, and I do post them on your calendar just as a notice to you, so you'll know that it's happening. You're not obligated to attend if you don't want to, but it's there for you if you want to. And there will be some recommendations. I don't know if Representative Terry at some point wants to talk about that, but they will be coming forward with some legislation to make some changes with regard to the process.
Right. So as soon as we, as soon as Government Oversight goes over this report, Representative Bickford, we will schedule it for our meeting schedule and look through it. But the report itself is available online at the moment, I think on the Government Oversight website, that shows our recommendations. And what you were asking, I think we'll be satisfied on that. So definitely take a peek. You can certainly ask me about it, or come with me on Friday if you want to.
Thanks.
Sure.
Okay. OPEGA, as part of its report, identified the complexity of the programs, both of them, for municipalities and for businesses. It can become somewhat complicated to determine which property is eligible for reimbursement or an exemption. And some municipalities are small and don't necessarily have the staff to be able to make those identifications. I mean, they have to make the identification if somebody applies for an exemption. If it's reimbursement, the only thing the municipality has to do is to evaluate the property and assess a property tax against it. So OPEGA's finding number 1 was that municipalities and businesses are impacted by challenges in determining asset eligibility for both Better and Betty. They are consulted with regard to Better property from time to time. And I've given you the report pages that identify these things. You'll also remember there's another provision in the Maine Constitution which requires the legislature to reimburse municipalities for a portion of the costs of new state mandated activities. The enactment of the Better program Betty program comes within that time period of requiring the legislature to reimburse municipality for mandates unless it's enacted by a 2/3 vote of the legislature with a mandate exemption. So the legislature can exempt itself from that, but hasn't with regard to Betty. So Betty reimbursements are required, which means that municipalities have to submit to Maine Revenue Services every year a request for how much they're going to be reimbursed. When Betty was first enacted, it was estimated that there would not be much effort on the part of municipalities. They get a request for an exemption, they'd have to process that, determine whether the business was eligible, and that would not be much of an administrative process for them. And for a while, well, I'm getting back down in here to the next category, municipal mandate reimbursement. OPEGA finding number 3, municipalities are not adequately reimbursed for mandated expenses. It was originally determined that a mandate reimbursement for a mandate to a municipality, $2 for each Betty application was enough. But the OPEGA report saying that that's not adequate to cover the constitutionally mandated state funding for administrative costs. It also requires Maine Revenue Services to gather that information about mandate costs and to provide information to DAFs, which then provides information to the budget people who put an appropriation into the budget for mandate reimbursement. OPEGA finding number 4 was that Maine Revenue Services had not provided DAFs with the information on Betty mandates that they administer. And the OPEGA report indicates that Maine Revenue Services had not been providing mandate information to DAFs, nor had DAFs submitted the required mandate reports to mandate reports, twice, I guess, to the governor or the legislature. I assume that that is being remedied, but we need to hear from Maine Revenue Services about that. So one of those issues is that mandate costs, according to PEGA, should probably be more than they are right now. I don't think the PEGA report went in as far as investigating how much they may need to be. It would probably vary by municipality, but more than $2 per application for a tax exemption. Although remember that with regard to tax exemptions, once it's exempt, it's exempt. The next year, the 3rd year, the 4th year, the 5th year, however many number of years it's there and exempt, the municipality really doesn't need to do anything except it's occurring to me that statement is not correct. They do have to do something because in order to request reimbursement, they have to determine how much property tax it would be paying if it wasn't exempt. So they can't just write it off their books and say, we don't need to worry about those people anymore. If they're going to get reimbursement, they have to tell Maine Revenue Services, we would have gotten X amount of property taxes from these folks, but it's Betty eligible, therefore we want our municipal reimbursement, which could be much more effort than $2. Anyway, okay, so the cost of the 2 programs in terms of, in this case, it's not a revenue loss, they're actual payments that the state of Maine makes under the Betty program. It's reimbursement to municipalities, which increases every estimated year. I'm giving you the years of FY20 through FY23. The ones that are the most easily accessible, they're in Maine's MRS's Red Book. So the figures are from there. About $50 million to about $61 million increase from FY20 to FY23. And and they estimate that there are 9,215 businesses, I assume, exempt in all. Better reimbursement is going down every year because the amount of property in the Better program is rapidly phasing out as it's no longer being used. So if it's not being used, it goes out of the program. But there still is an estimate, and well, their actual figures in FY20 of better reimbursement to businesses. 25.5 million estimated to go down to a little less than 19 million in FY23. They indicate that about 1,251, well, it's not an estimate, 1,251 businesses requested reimbursement for the 2018 property taxes. Maine Revenue Services estimates of its agency administrative costs for Betty as being about $88,000 and for Better being about $46,000. That's not, it's not like a mandate reimbursement or anything. It's Maine Revenue Services cost, but part of the tax expenditure review is analyzing how much it costs the agency to administer the provision, so that there can be a determination of whether the administrative costs are efficient and effective. I've already mentioned the length of the benefits. 12, well, originally 12 for Better, but now indefinitely, with the amount of reimbursement going down after the 12th year. Betty, no time limit on eligibility, just as long as the property is in use. Yeah, I should have started administrative provisions. Oops. Sorry. What's indicating MRS reimburses municipalities based on information the municipalities include in their annual municipal valuation return. Oh, okay. So that's where they provide their information on what the property tax loss is as a result of the exemptions. The annual municipal valuation return is obviously something they provide annually, and it's used by Maine Revenue Services to come up with a state valuation. So there's a ton of information in there. They come up with it every year, and you get copies of it. It's usually, I don't know, I want to say February when we receive it, but you will receive a copy. There's a ton of information in there about property taxes, and it is itemized by municipality. So you can check on your own municipalities in your own district if you want, or particular individualities, particular municipalities. If a constituent calls you with problems about a municipality, it will provide you with a lot of information in that report. It's really useful. So finding number 5, Maine Revenue Services documentation to support adjustments to Better Betty payments is inadequate. What this is addressing is that there is a provision in law that if a municipality feels that its reimbursement from Maine Revenue Services is not correct, it can appeal that reimbursement. And if Maine Revenue Services makes a determination that in fact they did make a mistake in the first place, they adjust the payment to the municipality. OPEGA looked at that process and decided that documentation, they considered documentation to not be adequate. They said, and mostly because their description was that it was recorded on paper only and sometimes do not adequately explain the reason for the adjustment. The inconsistency in explanations make it difficult or impossible to evaluate the accuracy of the adjustment and to identify recurring problems that could be corrected. So OPEGA, in evaluating the administration of the program, has identified this as an administrative issue, which you might want to speak with Maine Revenue Services about at a later date. That is the conclusion of my chart for Better and Betty. Any additional questions?
Any additional questions for Julie about the reports on Better and Betty? Representative Bickford.
Thank you, Mr. Chair. My question, Julie, is if you have a large company that happens to be in a TIF district, and because of being in that TIF district, they basically, for a certain number of years, don't pay property taxes, for example, and are they able to use the Betty program or not? I would imagine not, but we haven't really been told that.
I'm going to have to defer and note that as a question for Maine Revenue Services to get back to us on. I'm not 100% positive, and I don't want to make mistakes. It's better I think, to get an answer from the people who know than it is for me to maybe make a
Is it
mistake.
better or Betty?
It's better. You know, when the Betty program was created, it's BETE.
No, no.
This is the point at which you get one of my personal stories, but that I give myself leeway to do because I've been here longer than any other nonpartisan staff member. They created the acronym BETE, and they thought about it carefully. And I thought it was going to be BET, you know, as French, which as in bête noire, which I think means black beast. I'm not sure. But I didn't want them to call it Betty because Betty was my dear departed mother's name. So I have for years resisted calling it Betty. I know I have several times this morning, but you may frequently hear me trying to avoid actually calling it better and just calling it business equipment tax exemption rather than calling it Betty. But that's my story. All done.
All right. Any additional questions from members of the committee? Seeing none, I guess we'll conclude the review of the report on Better and Betty and jump right into the report on the Maine capital investment credit.
Yeah, let's see if I can manage to screen share that. Maine capital investment credit. Okay, making it larger. Got it?
Looks
Oh
good.
Lord, I've lost my audio. Oh, no, it hasn't. I've lost my audio. The people nodding are muted. That's why. I thought you were speaking. So I thought I'd lost my audio. But then I heard Senator Chipman. So I think the audio's there. The Maine capital investment credit is an income tax credit. And I did the same sort of information at the top here about why we're here and the taxation committee responsibility. And just note that OPEGA completed its evaluation of the Maine capital investment credit in February 2020, again as well. And for the same reasons of COVID, delays is what has held it up in terms of not getting full review all the way through from the taxation committee. The government oversight committee, in fact, that's not the taxation committee's. Well, yes, part of it is. 2021 is. The Government Oversight Committee endorsed the OPEGA report and sent it to the tax committee in January of last year, so just about a year ago. But the taxation committee, you know what your session was like last year, and you didn't get to it. But now you are. The Thursday, your meeting this Thursday also involves some reports that also are arriving since last year, although one new expedited review that has been OPEGA just completed in December. Okay, what is the Maine capital investment credit? It's an income tax credit based on eligible depreciation property placed in service in Maine. What most of you probably understand, maybe even better than I do, because I know many of you own businesses, depreciable property and what it means in terms of the Internal Revenue Code. If a business acquires depreciable property, which is generally, although it's very complicated, I guess, once you get into it, property which has a lifespan exceeding 1 year. But there are many different types, and the Federal Internal Revenue Code and IRS regulations go into great depth in putting different types of property into different categories and then assigning them a number of years over which the business can depreciate those expenses. So if it's depreciable property, business buys something. If it's non-depreciable property, it can deduct the cost of that purchase in the year in which it purchased it. If it's depreciable property, they have to spread that cost out over the number of years of the depreciation schedule. Okay. The Internal Revenue Code, Congress in the last 6-7 years or so has, in a number of instances, made some changes in the federal Internal Revenue Code, which we conform to with regard to the treatment of depreciated property, generally speaking, and adopted a couple of incentives a variety of times, the most recently being last year or 2020, I'm not sure which, I think it was 2020, to create something called bonus depreciation. So to permit businesses to take more than the depreciation charts would ordinarily allow them in the first year in which they purchase new property. It was an incentive to make it easier for businesses to acquire new equipment because of recession issues and business cycle issues. When the economy's bad, or if COVID is decreasing business activity, Congress has increased bonus depreciation. With regard to the COVID year, the most recent one, they actually enacted a 100% bonus depreciation so essentially it was permitting the business to declare the cost of that property 100% in the first year. A lot of states, most states conform in one way or another to the Internal Revenue Code, but most states looked at that and thought, that's going to be a big cost to us. It may be something the federal government can feel that it can afford or push on for future taxpayers to have to pay for in a deficit, but states do not generally have the luxury of creating deficits. So a lot of states, Maine included, decided to not conform to the bonus depreciation. So Maine did not. We do not conform to the federal bonus depreciation. However, what we created was this Maine capital investment credit. It dates back longer than the most recent 100% bonus, because there was in a previous economic downturn it wasn't 100%, but it was more of a stepped up depreciation schedule, which Maine also did not conform to at that point. But what Maine created at that point instead was the Maine Capital Investment Credit, which provides businesses with eligible depreciable property with the ability to claim an income tax credit on their tax return for a portion of the bonus depreciation. My recollection is the reason why we did it that way rather than conforming was that with regard to a credit, we could restrict a credit to a reward to a business which was engaging in capital investment in a project in the state of Maine. Whereas if it was in another state, we would not have to, they would not be eligible for a credit under Maine income tax law. So we're talking about interstate businesses that have operations in more than one state and pay taxes in more than one state. With depreciation, the depreciation is company-wide. So if they have a depreciable amount, that's their depreciable amount. Maine gets X percent of their depreciable amount, but the depreciation is not related to property that they purchased in Maine. That's about the limit of my understanding of the Maine Capital Investment Program. I'm happy to take notes of questions for more details, and we can have Maine Revenue Services do a better presentation on that, but that's my understanding of the way it works.
Any questions from the committee about the Maine Capital Investment Credit report?
Nope. Okay. What is the purpose and intent and goals? There are no specified statutory purposes, intent, or goals for the Maine Capital Investment Credit. It's fairly obvious. OPEGA identified the purposes of the evaluation as identified the goal of keeping relative to conformity with the Federal Internal Revenue Code, so that the business would be more or less financially in the same place as they would have been under the, if we had conformed totally to the federal bonus depreciation. And also identified the goal of providing an incentive, the same incentive probably at the federal level, for businesses to make capital investments, although in this case in Maine, since we have a credit that relates to investments in Maine. The beneficiaries are businesses investing in qualifying business property in Maine. They're able to claim federal bonus depreciation. They're able to claim the credit for federal bonus depreciation property, with the exception of certain utility and communication businesses. I think the theory with regard to communication and utility businesses are also exempted from Better and Betty. I think the intent of this was that utility and telecommunications businesses were regulated, and as regulated businesses, their rates included the amount that they needed to pay their taxes. And that's the way that rates are usually regulated, is that businesses are allowed to recover through their rates the amount they need to pay their taxes. Makes sense. But therefore, the state did not to be reimbursing them for those taxes, as they were collecting the money to pay their taxes from their customers. That's my recollection of the rationale for that exemption of that type of property. Impact of complexity on the credit. OPEGA finding number 1 is that the credit is complicated for businesses. It requires them to maintain essentially 2 separate books of depreciation, because their appreciation on the federal level is going to be different than the depreciation on the state level. And the OPEGA report comments that the existence of the credit instead of conformity to bonus depreciation may result in discouraging some businesses from investing in Maine.
Excuse me, Lena, can you let Matt Pouliot in, please?
I'm here now.
Oh, all right.
I've been experiencing issues with technical systems even outside of the legislative technical system lately. I don't know what's going on. I think maybe there's sunspots or something. I don't know. Anyway, OPEGA finding number 2 is that the credit is unlikely to encourage businesses to expedite their capital investment to any significant degree. This was based upon their sort of generic overview of the reasons why businesses make investment decisions. And they OPEGA report identifies that businesses are more likely to be driven by economic conditions and short-term sales and earnings outlook than by tax considerations. We'd need to hear from them more if you wanted to talk about that more. OPEGA finding number 3, the credit is unlikely to encourage businesses to choose Maine over other states when making capital investments. The simplicity of conformity is, according to OPEGA, may be potentially more attractive than the benefit provided by the credit. The cost of the credit, this is an income tax credit, so the cost is in the form of lost income tax revenue. Increased from FY21 2.8 million, estimated in FY22 and 23 to be $4.25 or $5 million. The legislature and the administration in general as well, I don't want to, that's going to make it sound like it's a blame. I don't mean it's a blame. It has been very difficult for agencies who have the responsibility for estimating the economic impact of our current economy to actually accurately forecast revenues. You're seeing that in the form of the large surplus in revenues that the legislature will be confronting this year. The legislature attempted to estimate what revenues were going to be, and the goal is always to get as close to actual revenues as possible. The intent of an estimate. It's not the intent to have a large surplus. The intent is to be close. So one of the things that affected that estimate was that it was assumed that there would be a lot less economic activity because of COVID than there has turned out being. So so the revenues in general have been larger than anticipated, and the opportunity for investment is there. That's sort of indicating that it's likely that investment has also been higher than estimated, business investment over that time period. Administrative provisions the credit is obtained by claiming an income tax return. Maine Revenue Services administers it. They don't separately identify any cost for that particular activity. They're just looking at the forms and judging whether the taxpayer is eligible the way they would any other credit that's applied for in a form. Questions?
Okay. Any additional questions from members of the committee? Not seeing any. So does that conclude your review of the report on Maine Capital Investment Credit?
It does.
Okay. We don't have anything else on our schedule for today. Any announcements, anything from you, Representative Terry, or should we go ahead and adjourn?
I think we can go ahead and adjourn. I think I want to just throw out there that next Tuesday will be our first public hearing, and those are some MRS technical changes, you know, the ones that we will go through randomly. This year, the IRS has moved back the first week of filing. The IRS has changed their scheduling for filing your return a week early. So with those technical changes, those are usually done, you know, relatively quickly, so MRS can start their work on time. We're going to be behind the time anyway because of that 1 week allotment from the IRS. So if we can make sure that everybody is on time on Tuesday, we're going to go quickly into that first public hearing and then move right into work session. The goal is to have the bill passed, hopefully, I mean, assuming that there are no difficulties with that, but passed and in the clerk's office by 2 o'clock on Tuesday afternoon. So it can get on Wednesday's schedule. We'll all be meeting and doing floor votes on Wednesday. So MRS can have the proper language that they need to do their filing and to be able to catch up as quick as possible. So that's the only thing that I ask, is if Tuesday can be a quickie, everybody here on time, hopefully in and out pretty quick too, right, Julie?
We would pass that bill as an emergency measure, pass it from the committee, get it out on the calendar for Wednesday to pass as an emergency, so it takes effect right away.
Yep.
Okay.
And again, they're usually just those MRS bills are usually just super technical things like date changes, etc. I'm not sure exactly what's in there at the moment, but it should be pretty simple. Julie?
Go ahead, Julie.
Yes, thank you. I just wanted to do a little bit of a clarification.
Oh, yeah.
That bill is actually technical changes with regard to only one item. It's with regard to the ETIF program. The legislature made some changes to the ETIF program last session, and there were some changes made in the revisor's office that Maine Revenue Services didn't see until after it got enacted that caused technical problems for them. So they want to correct those because it does apply to the changes that were made last session, does apply to the current filing season. And they want to make sure that it gets enacted as soon as possible, so people who are filing their taxes can be filing them the way they were intended to be, as opposed to the technical difficulty that exists. We have the only change to that, no, not the only change. There will need to be committee amendment on that for the fiscal note because you have to have a fiscal note on everything. But the fiscal note will simply say that the current revenues forecasts have already taken into consideration because they were forecast assuming that it would be done correctly before they discovered the errors even. So that is that bill. There will be a larger, big technical changes bill. I'm not sure if that one's been printed yet. Might have been, I'm not sure. Yes, I think it has been. But there's not a rush on the larger one. The rush is only on this one.
Go ahead, Representative Bickford.
Thanks, Mr. Chair. Just a question to you and Chair Terry. We have to have 60% of our bills out by February 11th. That's 3.5 weeks.
Mhm.
Where are we going to be on that?
Honestly,
Yeah.
I think probably pretty, not super close, but pretty close, like maybe 40-45% actually.
Oh, good.
We've
Yeah.
actually- Yeah, I mean, we've only have like 21 carryover bills and I think 6 that have come to us since we adjourned. So we have less than 30 bills on our
Yeah.
bill right now. So
Okay, that would be very helpful to us to get our work done super early rather than drag it out. Thanks.
yeah, and I guess I'd just echo Representative Terry's comment about, being here when we're scheduled to meet, particularly
Yes.
next week when we get started with public hearings and work sessions, because the public will be wanting to testify and be waiting to come into our meeting. And if we're waiting for quorum, that doesn't
Yeah.
look very good and everybody's kind of waiting. So go ahead, Senator Pouliot.
Yeah, I just, for those of the members that weren't on earlier, I will not be here until returning until late the 25th. So I'll be in session on the 26th and then here for our meetings on the 27th, but I won't be here next Tuesday.
And if any members can't be here, which we all have different things going on and other committees and other things in our lives, just if you could reach out to Chair Terry or myself in advance so that we know that and we can call other members and just make sure that we have quorums so we can start on time, that would be super helpful.
Mhm.
Anything else, Representative Terry or any other members of the committee? Are we all set for today?
Everybody good?
Great.
Awesome.
Um,
Thanks,
do
everyone.
you have anything, Julie or Lena, that we should know about before we adjourn?
Nothing more. Just there's the meeting on Thursday. If you want to tune into the Government Oversight Committee on Friday.
Will we have a link for that?
Yeah, I'll send out the link, just the link next time.
Good, thank
Instead of that whole paragraph, yeah.
you.
And the Government Oversight Committee would be a YouTube, so if you just go to legislative YouTube channels and you'll find them there.
All right. I guess we're all set for today, so we'll go ahead and adjourn the meeting of Taxation Committee, and we'll see everybody Thursday at 10 o'clock.
Have a good day, guys.
Thanks, everyone.
Yeah.